The merger is not a change of control, so a lot of people say the regulatory is going to move a lot faster than your typical deal. Is that true?
We believe so. Great to be here, David. We think we're going to close sometime in December, so things are moving along. We benefit, as you say, from National Amusement's common control in the context of the merger process.
All right, so December will be upon us fairly soon. You know, it's been about a month since you announced the deal. The stocks did not react particularly well, at least given the weeks, months, years of speculation, many waiting for perhaps what would have been a positive response. Are you disappointed in the market response so far in both stocks?
Yeah, look, clearly we're disappointed with how the stocks have reacted. You know, I've spent a lot of time in the last 4 weeks and really the last probably 2 weeks in particular talking to investors, making sure they understand the tremendous opportunity ahead of Viacom CBS. You look at the assets that this company unites, whether it's Paramount Pictures, an iconic 105-year-old film studio, the powerhouse CBS, broadcaster, station group owner, studio, D2C operator, Showtime, which is really, you know, a preeminent and a storyteller that's really come to the fore in the last 5 years, Simon & Schuster, preeminent consumer publisher. We think that's a tremendous opportunity. You look at it, a library of 145,000 television series, 3,600 films, participation in news and sports and obviously entertainment, scripted, unscripted, on a global basis. It's a tremendous opportunity, and it really positions us to be a preeminent content provider to the world. We are going to be singularly focused on maximizing the value of that content, both through our owned and operated platforms and to third parties. You'll see us begin to execute that strategy as we close. That's going to enhance our opportunity to work with distributors and advertisers all around the world, and it's going to accelerate our transition to these next generation platforms in the streaming space. So we're tremendously excited.
Right. You mentioned, of course, speaking to investors, which you will be doing as well today here in about an hour and a half. I've also spoken to some, as you might imagine. They were very disappointed by the $500 million synergy number. Many pointed to that initially and said, it just seems much lower than we'd anticipated. We're not sure why they chose that number. What do you tell them?
So that was definitely a topic of conversation with me, with investors as well. Here's what I'd say. Look, the $500 million, first of all, it's a cost-only number. It's a synergy number that will drop to the bottom line. It's one we have clear line of sight and will deliver over the next 12 to 24 months. So that's a bankable number. I'd also, in my discussions with them, talked about the fact that, sure, we have higher numbers we're looking at. We're going to look for more opportunity. And as we get into this process, I wouldn't be surprised if we find that. Now, that's the cost side. The revenue side in that number is zero.
Right. It's
but
all
ultimately,
cost synergies you're talking about, now 12 to 24 months after the
right.
deal.
But ultimately, the reason you do this deal is for revenue synergies. And we see 4 buckets of revenue synergies. Again, zero in the $500 million number. We see substantial distribution revenues in this deal. Look, we will, on closing, be the leading market leader in television's audience share in the United States, 20% of total day, 22% of prime time. That makes us a partner that video distributors absolutely need to have as part of their offering. We think that's a substantial opportunity. Likewise, in the advertising space, we are not only 22% of prime time, we are number one on every single demographic. And you add to that the advanced marketing solutions that Viacom brings to the table, and we, as a solution provider for advertisers, are the clear market leader. We think that leads to substantial synergies in the ad space. You go to product licensing. In many respects, it's a back to the future play. This company used to be together, and when it was together, it licensed film and television product together. That's an opportunity that we see in the marketplace as well. That'll drive synergies on the product licensing side. And finally, the streaming space. Now, that's a different kettle of fish, but that also is a place where the combined assets will enable acceleration and substantial progress. So 4 big sets of revenue synergies, and that's ultimately why you do the deal.
But, you know, I wonder whether investors, though, will look at the added scale, of course, of this, but say, hey, you're still in a business that is being eroded every day. Yes, it's great to be 20% of the market, but that market is getting smaller and smaller in terms of at least what we have dealt with for many years. Streaming is sort of where they want us focused in terms of a potential growth opportunity. I mean, yes, you may grow the synergies or revenue increases as a result of being together may be significant, but aren't you facing a declining market overall?
Now, what we see is a consumer market that's segmenting. We've seen that for the last couple of years. Still, the majority of consumers today in the United States are big bundle consumers.
They are.
Below that,
but they're going away, Bob.
Well, below that, you have smaller bundles that have opened up.
Yep.
At the high end of that are over-the-top bundles that are substantially similar to the big bundle. At the low end are true skinny bundles, non-broadcast, non-sports in the case of Philo. That's a growth segment in aggregate. Below that, you obviously have SVOD players, folks like Netflix, which is also a growth segment, one we're supplying directly through our studio productions. And then below that, you ultimately have ad-supported free, where we have the market leader in Pluto. We see that segmenting marketplace, and what we're focused on as a company, and I think it's different than other companies, is focusing the widest accessible market from a consumer perspective, and that's all segments. You look at us today in the big bundle and smaller bundle segments, we are better positioned together than we were independently. You look at us supplying the SVOD space, we're a major supplier of original content to that. We're not only making content, we're making hits. And by the way, every single one of the services that are either in the market today or are announced are doing business with us on an original production basis, so we're in clear demand, particularly as other people cut back from that. And then again, we think the free space is a substantial opportunity as supported free.
And you've been on with us talking about Pluto in the past and what you see as the growth path there.
And that's the way you address the largest total accessible market. And that's what Viacom's focused on, taking this tremendous content asset, which includes both assets in the library as well as new production, maximizing the value of that across this whole distribution base.
But what about the investment that you'll need to make? And I ask that because Todd Younger, he's been a negative analyst. To your credit, you brought him in recently, which he acknowledged, to talk to him and try and explain things to him. He came out of that thankful for the opportunity, but continued to say that in his opinion, Viacom CBS must take one of two paths, either announce this transformation with no investment or announce an invest and grow plan. And in either scenario, the stock's going to underperform because it's going to cost so much darn money if you have to invest.
Look, if you look at the scale of spending the combined company Viacom CBS is, we spend about $13 billion. Why is that important in the context of this? One is because that scale of spending puts you in a club where you have a flow that ensures that you have state-of-the-art capabilities in terms of developing content, that you have a flow of talent in terms of wanting to work with you. So that's critically important, and Viacom CBS gets you that. The other thing it gets you is you look at how you spend that money. And we obviously spend it across film and television. In the film space, as you well know, David, we're on a very nice trajectory at Paramount. They'll have 16 films in 2020, starting with Gemini Man and Terminator in the next 2 months. Very excited about that. And then in the television space, very substantial ongoing production. And what we're going to focus on, again, through our broader set of owned and operated properties, as well as third party, is maximizing the return on that, whether that's where you put library product, exclusive, non-exclusive, where you put new production, and importantly, how you fill partner demands. We've spent the last 3 years at Viacom working closer and closer with our distribution partners, and these distribution partners are important in the over-the-top space as well. And that's where we see the substantial opportunity going forward. So Todd is certainly entitled to his opinion. By the way, I stuck to Todd quite a bit about this notion of total addressable market, and I'm 100% convinced that the Viacom strategy will get us to a larger total addressable market enabled by things like mobile, and that in turn will unlock extraordinary value for this company.
And yet, Bob, there are still those who say the scale is not enough. Having just heard all the scale that you have, and they still say you're still too small to actually compete overall, whether it's with a robust streaming service or to the point you're making of hitting all of these different areas. I assume you disagree with that, but what do you say when others say, well, you're not big enough to compete with a Disney or to compete with some of the other giants that are out there?
Well, I disagree with it, as you say. I mean, we just did a transformational deal, which unites a tremendous set of capabilities. But let's talk about us in the streaming space and what makes us different, because I think there are a number of things. One is we are not a pure SVOD strategy. We are a hybrid of free ad-supported and pay. That means you can bring in the widest accessible number of consumers.
We've got all access on CBS side. You've got Pluto as well.
Pluto as a free service into a pay portfolio, which is CBS All Access, Showtime, Noggin. We're launching BET Plus later this week. So we think that integration is tremendously attractive, and it's a differentiator.
Or does that stay what it is? Do you know?
Look, we will see how the portfolio, particularly on the pay side, evolves over time.
Peacock is taken, by the way, just so you know.
I heard that this morning.
Yeah.
I think it's an awesome brand. But again, so point one is it's a hybrid of free and pay. Point two is look at the content collection in it. We have, sure, entertainment content, not only scripted, but unscripted. We're a leader in both. We have news content. We have sports content. All of that is national content. We have local content, i.e. on a market-by-market basis in the United States. We have international content. And by the way, we serve every demographic. So a second differentiator is we are going to bring substantial content, breadth, and depth to this space. The third thing is this notion of partnership. I fundamentally believe in partnership. Anyone that thinks they can serve the world's consumers through one slice, D2C, SVOD, I think is missing the bigger total addressable market opportunity. Look at what we did with Pluto. No one understood that. Now we're working, and they thought, oh, it's a free D2C product. On some levels it is, on some levels it isn't. We're working today with Comcast, with Cox. We're going to announce.
Is there real programming on Pluto that a lot of people want to watch, Bob?
Absolutely. When we announced the deal in January, we had 12 million monthly active users. When we had our third quarter earnings call in August, we had announced 18 million monthly active users, 50% increase in 6 months, U.S. only. By the way, if you look at time spent per active user, it's growing even faster. We have 160 content suppliers, including, by the way, the NFL, on the platform. We're rolling it internationally. So there's tremendous demand, and we've started to monetize it aggressively in the ad market. So that play is tremendously valuable, and it's a piece of our streaming strategy.
We're running out of time. You mentioned the NFL. The contract, it's still a bit of ways away, but these things sometimes can be negotiated ahead of time. Are you confident that CBS is going to keep the NFL?
I'm confident that Viacom and CBS will have a long-standing and highly productive partnership with the NFL. Why? You look at what they get from CBS, they get what everybody thinks, broadcast reach. For a mass market business like the NFL, that's important. Second thing they get that people don't really talk much about is very high quality production. CBS produces multiple games per week for them in the season. That's the way their product is exhibited to the American consumer. They care deeply about that, and they have great trust in CBS. Enter Viacom. You get two other things that are important to the NFL. One, you get young audience reach. CBS is, largely speaking, older audiences. Viacom is younger audiences, both linear and on demand. And younger audiences are important to bring into the brand from a long-term perspective. The second thing Viacom brings is reach outside of the United States. That also is critical to long-term brand development. So, as you look at Viacom, CBS,
it's a good
four things come to the table.
Right.
That package is very hard to replicate.
Although something else they care about is this.
Sure, they're going to want a bigger check.
Yeah,
absolutely.
and you can pay it.
Absolutely. The
Bob,
financial strength of the combined company is second to none.